Picture this. It is late at night in a glass tower in lower Manhattan. The trading floor is dark, but in a hidden server room, new code is going live. Not for a meme coin, not for a casino app, but for the core systems that move trillions of dollars every single day. While social media laughs about dog coins and failed exchanges, the real story is unfolding in these quiet rooms. And if you work in finance, tech, or even just care about where your money sleeps at night, this shift is going to touch you directly. Because here is the twist almost nobody outside the industry sees. While the public thinks crypto equals Dogecoin jokes, NFT scams, and the spectacular collapse of FTX, banks and asset managers are quietly wiring their infrastructure onto blockchain rails. Not to speculate on your favorite token, but to rip out ancient, fragile plumbing that costs them a fortune to maintain. In a minute, we will get into the smart contracts, private chains, and tokenized assets they are betting on. But first, you need to understand why the institutions that once mocked crypto are now rebuilding their own systems on its core ideas. Most people still see crypto as a circus. Meme coins pumping and dumping, influencers shilling tokens that vanish in a week, and headlines about billions of dollars vaporized in bankruptcies. That chaos is real, but it is also a distraction. Behind it, in boardrooms and risk committee meetings, the conversation is very different. Executives are not asking which coin will moon. They are asking how to move off batch processes, fragmented ledgers, and settlement systems that literally date back to the 1970s. Here is the scale that almost nobody talks about. Retail traders chasing meme coins move billions. Global finance moves in the hundreds of trillions. Boston Consulting Group estimates tokenized real-world assets could hit $16 trillion by 2030, making the last NFT mania look like a rounding error. When a single asset manager pilots tokenized collateral for a derivatives book, the notional value can exceed the entire market cap of a mid-tier cryptocurrency. This is not about moonshots. It is about shaving a few basis points of cost from flows so large they reshape balance sheets. So what exactly are they building? Think of it as new financial plumbing. Institutional players are using the same primitives that power Ethereum-style smart contract platforms: Solidity-based contracts, EVM-compatible chains, and interoperable networks like Canton. The promise is near real-time settlement, programmable compliance, and 24/7 markets that do not shut down at 4 p.m. Eastern. For a bank juggling dozens of ledgers and overnight batch jobs, that is not ideology. It is a straight-up operational upgrade. But here is the part that separates hype from reality. Enterprise grade in crypto does not mean Bitcoin, but bigger. It means infrastructure that can survive a risk committee. Banks and hedge funds need audited data feeds, deterministic behavior, strict access controls, and latency measured in milliseconds, not vibes from a Discord server. Companies like Amber Data sit in this plumbing layer, turning raw blockchain noise into clean, schema-stable datasets that plug into the same stacks used for equities, foreign exchange, and credit. If you are imagining a trading app, stop. Amber Data and similar firms ship data infrastructure, not meme coin buttons. Normalized price feeds, order book snapshots, on-chain transaction traces, derivatives metrics, all exposed through API endpoints or data platforms like Snowflake. Quant teams do not want to parse 15 different blockchains by hand. They want funding rates, implied volatility, liquidity depth, and arbitrage spreads in formats their models already understand. And compliance teams want KYC and anti-money laundering aware datasets that can flag sanctioned addresses and suspicious flows automatically. Here is where the stakes get very real. A BlackRock-sized institution cannot just scrape a retail exchange API, hope the rate limits hold, and then wire billions based on whatever JSON comes back. They need service-level agreements, regional redundancy, versioned datasets, and support contracts that look like traditional market data deals. Because when a basis point error can move 8 figures, data integrity becomes existential. A misparsed Ethereum reorg or a delayed Oracle update is no longer a nerdy edge case. It is a direct path to mispriced options, under-collateralized loans, or cascading liquidations. Under the hood of this new plumbing sits Wall Street's new automation engine, smart contracts. Forget the mystical branding. They are closer to vending machines than robot lawyers. You feed in inputs: who is paying, what asset moves, which conditions apply, and the code automatically spits out the agreed result on a blockchain like Ethereum. Decentralized finance wired this primitive into full-blown market infrastructure. Protocols like Uniswap proved that automated market makers and liquidity pools can handle tens of billions in volume without a central dealer. Institutions are now studying those designs not as curiosities, but as blueprints. Imagine a permission liquidity pool where only KYC-approved counterparties can participate. Smart contracts enforce whitelists, position limits, and trade windows down to the block. Oracles then act as the eyes on the real world, feeding in foreign exchange rates, stock prices, and interest rate curves. Suddenly, interest rate swaps can reset automatically, and structured notes can pay out the instant an index crosses a threshold. Settlement becomes a code path, not a week-long post-trade process. Now add collateral to that picture, and the impact jumps again. Tokenized collateral locked in contracts can move intraday with rules that automatically haircut assets by volatility, trigger top-ups when loan-to-value ratios breach limits, and release collateral instantly at maturity. Derivatives terms that once lived in I, S, D, A, P, D, F documents become parameterized code. Regulators are already sketching guardrails for this world. Recent interpretive letters from the Office of the Comptroller of the Currency outline how national banks might run smart contract-based settlement and custody as core services, not side experiments. But wait, you might be thinking, what about the chaos? The hacks, the FTX collapse, the burner wallets. Here is the pattern break. Institutional money does not want the Wild West. It wants the efficiency of blockchains without the chaos of anonymous traders and Discord governance. That demand is driving a massive, quiet shift toward private, permissioned blockchains. Think of them as blockchains that look and feel more like Swift, with shared state and programmable logic, but with access controlled by legal contracts and identity checks, not browser wallet pop-ups. Canton Network is one of the clearest examples of this institutional pivot. Built around the DAML smart contract language and led by digital asset, it acts as a network of networks linking multiple permissioned applications into a single interoperable fabric. Major custodians, exchanges, and banks are experimenting with tokenized cash, securities, and collateral on it. Unlike public chains that broadcast every trade to the world, Canton uses a need-to-know data model. Only directly involved parties and designated regulators see transaction details. Everyone else just sees that the global state remains consistent. This is where regulation stops being an afterthought and becomes part of the design. Private networks bake in KYC and anti-money laundering checks at the identity and transaction layers. Every on-chain action is tied to a verified legal entity. Smart contracts can enforce travel rules, blacklist sanctioned addresses, and generate regulator-ready audit trails automatically. Not your keys, not your coins turns into not your problem, because custody, identity, and risk all live inside a governed environment regulators already understand. Now, zoom out to one of the biggest shifts of all, the real-world asset revolution. Real-world assets are anything that exists off-chain, but gets represented on-chain as a digital token. A Manhattan office tower, a bundle of auto loans, a 3-month United States Treasury bill. You are not putting the building on Ethereum. You are putting the ownership rights, cash flows, and legal agreements into a programmable format. A custodian holds the underlying asset, then issues tokens that map one-to-one to claims on that asset. The benefits show up fastest in markets that are huge but painfully illiquid. Real estate, private credit, even treasuries typically trade in chunky blocks on business days via phone calls and PDF documents. Tokenization breaks that model. It enables fractional ownership down to tiny slices, 24/7 secondary markets, and instant or near instant settlement. You can buy a $100 slice of a building that used to require a $100,000 ticket. Private credit funds can rebalance positions intraday instead of quarterly. And tokenized treasury products start to look like on-chain, stable instruments. Once assets live on-chain, they become powerful collateral. Instead of wiring securities into a custodian and waiting hours for confirmation, a smart contract can lock real-world asset tokens in seconds and prove collateralization programmatically. Banks and clearinghouses are already experimenting with this for repo, margin, and intraday liquidity. CoinGecko tracks tens of billions of dollars in real-world asset-linked tokens, and institutions and networks like Canton are piloting tokenized bonds and funds. This is not a meme trade. It is a new collateral layer and a new way to move trillions. Underneath all of this, the developer stack for crypto is starting to look a lot like a classic 3-tier enterprise system. At the bottom, protocol engineers design the base blockchains, arguing over consensus algorithms, gas accounting, and data availability. In the middle, smart contract developers encode financial logic. At the top, D-app builders create user-facing products that abstract away the complexity for banks and end users who will never touch a command line. The casino narrative is giving way to a clean hierarchy that lets institutions plug in without learning how to be cypherpunks. Here is the most important pattern to notice. This takeover is happening in stealth mode. You will not see it in meme coin charts. You will see it in settlement windows shrinking from T plus 2 days to near instant. You will see it in back offices that no longer need armies of people reconciling ledgers. You will see it in new products like tokenized funds or on-chain treasuries that feel oddly seamless. By the time most people realize what changed, the new rails will already be the default. And this is where AI quietly enters the picture. Real-time, tick-level crypto data, on-chain events, and even application usage metrics are being fed into AI-driven trading systems that make decisions in sub-second windows. But those models only work if the underlying blockchain data is as clean and reliable as traditional market data. That is why the boring plumbing layer matters so much. It is what turns digital assets from a speculative playground into something institutional capital can actually trust. So, what does this mean for you? If you work in finance or tech, your next career move might be hiding on the blockchain, but not where you think. It is not just trading tokens. It is designing smart contract workflows, building compliant data pipelines, architecting private networks, and figuring out how to tokenize the assets your firm already owns. Web3 did not die. It just got a real job inside the walls of the most conservative institutions on Earth. As the circus continues on the surface, the real transformation is happening in the plumbing underneath. Blockchains are quietly becoming a radically modernized version of Swift, one API, one pilot, one private chain at a time. The question is not if this will reshape Wall Street. It is whether you will understand it early enough to benefit. If you want deeper dives into private chains, real-world assets, or the careers this new stack is creating, tell me in the comments. Hit subscribe if you want to follow how crypto is quietly eating banking and Wall Street from the inside out, not just the meme coin drama on the surface. Drop a comment with where you work or what you are studying.